Welcome to This Explainer. Picture this. You've just sacrificed your entire weekend to the tax gods. You've double-checked your numbers, you're totally confident, and you hit submit right on time. You breathe a massive sigh of relief. The hard part is over, right? But then, weeks later, an official audit letter arrives in the mail. And here's the crazy part. It's not because of fraud or some huge tax evasion scheme, but because of a tiny, almost invisible mistake you didn't even know you made. So the crucial point here is that millions of people make this exact same mistake every single year. It targets everyday, honest taxpayers just trying to do the right thing, and most of us don't even realize we've stepped on a landmine until it's far too late. Now, you might be wondering, are audits really just for the wealthy? For decades, we've kind of just assumed that average earners are completely off the IRS radar. But relying on that assumption is incredibly dangerous today. Let's uncover the reality of what's actually happening. Section 1, the hidden audit trigger, simple filing mistakes. The vast majority of tax problems don't begin in some shady backroom. They begin with totally innocent errors. What if I told you the absolute biggest threat to your financial peace of mind isn't a complex loophole, but simply a forgotten side gig? That brings us to Section 2, the income matching trap. Okay, let's dive into this. I'll actually admit something here. I once had a total panic attack over a tiny forgotten freelance payout from months prior. Modern tax systems are literally digital detectives. They're actively cross-referencing your return. Miss a single weekend gig, a side hustle, or some small investment income, and an automated discrepancy flags you instantly. It's like a giant puzzle where they already have the edge pieces. So let's say you reported every single penny perfectly. Great, you're safe, right? Well, what about the money you claimed to have spent? You claimed the deduction, but can you actually prove it? Let's look at Section 3, the deduction trap. And this brilliantly illustrates the core issue. Claiming deductions is completely legal, we all know that, but it is incredibly dangerous without proof. Business expenses, charitable contributions, that expensive gear for your home office, these are perfectly legal claims that instantly become massive liabilities the second you lose the paper trail. Which leads us to a pretty suspenseful reality. Imagine the system randomly flags a huge purchase you made for your home office. You know you bought it, but your receipts are just gone. What actually happens when the paper trail vanishes? Section 4, the documentation dilemma. It's a brutal equation, honestly. Missing receipts literally equals a missing defense. When the magnifying glass is suddenly on you, just hoping a transaction is somewhere in your digital bank history is absolutely not good enough. You're basically showing up to a legal fight with no armor. Now, if you thought standard filing was a minefield, hang on tight. What if your boss is actually you? Being an entrepreneur or a freelancer introduces a terrifying new level of vulnerability. Section 5, self-employment red flags. Now, what's really interesting about this is how easy it is to slip up. I used to accidentally use my personal credit card for business software all the time. But mixing personal and business expenses, relying on poor bookkeeping, or having missing invoices, that makes you a prime, glowing target for sudden audits. And this brings up a very universal, highly relatable temptation. The deadline is looming. It's 11 p.m., and a crucial receipt is lost. Is it ever actually safe to rely on your memory and just guess your numbers? Section 6, the danger of guessing. It's a massive psychological trap. Rounding numbers and relying on your memory feels so harmless in the moment. You think, it was about $100. Actually, scratch that. Doing that is the exact thing that gets you caught. Absolute accuracy, backed by rock-solid evidence, is literally your only true protection. So the ultimate question remains, how do you escape this suspense? How do you completely bulletproof your tax return so you can actually sleep at night and avoid these invisible traps altogether? Section 7, how to protect yourself. Let's see how this builds into an actionable survival guide. It's simple, but absolutely crucial. Keep detailed records. Track every single income source, no matter how small. Save and digitize your receipts. Verify everything before you hit submit. Review it carefully, and this is the big one, stay organized year-round, not just in a panic during April. Because ultimately, the underlying mystery of this whole explainer is solved right here. It's not fraud, it's carelessness. These nightmare audits are almost always triggered by simple, entirely preventable errors. And the good news? That means you have the power to stop them before they ever happen. Now I want to pass it over to you. What's the biggest tax mistake you've ever seen, or maybe even made yourself? Did any of these hidden red flags surprise you? Drop your stories in the comments below to help others out. Thanks so much for joining me in this explainer. Stay accurate, stay organized, and I'll catch you next time.